Many investors assume that stocks only move when there is breaking news, earnings, announcements, or major headlines, but in reality, some of the most significant price movements occur quietly, without any visible news at all. And understanding why this happens is essential to truly grasp how financial markets work. At its core, the stock market is not just a reflection of news, but a reflection of expectations, positioning, and supply and demand, which means prices often move based on what informed participants anticipate rather than what the public already knows. Long before news becomes public, institutional investors such as hedge funds, mutual funds, and pension funds conduct deep research, analyze data, speak to suppliers, track industry trends, and build forecasts. And when they begin acting on this information, they do so gradually, accumulating or distributing shares in a way that does not immediately attract attention, causing prices to drift higher or lower without any obvious catalyst. As legendary trader Jesse Livermore said, "The market is never wrong, but opinions often are, and the market often moves because it is responding to unseen forces rather than visible headlines." Another key reason stocks move without news is changes in liquidity and order flow, as large buy or sell orders from institutions can shift prices simply due to volume, especially in stocks with limited liquidity, where even moderate demand can push prices significantly. Technical factors also play a major role, because many traders and algorithms make decisions based on charts, patterns, support and resistance levels, moving averages, and momentum indicators, meaning that when a stock breaks a key technical level, automated systems and traders may pile in or exit simultaneously, triggering sharp moves without any fundamental announcement. Market sentiment and psychology further explain these movements, as fear, optimism, greed, and uncertainty constantly influence investor behavior. And when sentiment shifts collectively, stocks can move even if nothing new has occurred, reinforcing John Maynard Keynes' famous observation that markets can remain irrational longer than you can remain solvent. In addition, broader market dynamics such as changes in interest rate expectations, currency movements, commodity prices, or sector rotation can cause individual stocks to rise or fall, simply because capital is flowing in or out of a particular industry, regardless of company-specific news. Insider activity and quiet positioning can also contribute, as executives, early investors, or sophisticated players may adjust their exposure based on internal expectations, future plans, or risk management strategies. And while this activity is regulated, the resulting price impact can still appear mysterious to the public. Another often overlooked factor is the role of derivatives markets, such as options and futures, where hedging activity and changes in implied volatility can force market makers to buy or sell the underlying stock, creating price movements that seem disconnected from any narrative. Importantly, news itself is often a lagging indicator rather than a leading one, meaning that by the time a story appears in the media, the market has already priced it in, which is why stocks sometimes move first and the explanation comes later, validating the saying, "Buy the rumor,